In this video, we're going to take a look at another interesting high-yield dividend stock. As of the making of this video, it currently offers a yield of nearly 16%, and they just recently paid a massive special dividend. The company we'll be looking at today is BlackRock TCP Capital Corporation, ticker TCPC. This is a business development company that specializes in direct equity and debt investments in a wide variety of businesses. They make investments in debt securities, senior secured loans, junior loans, mezzanine, senior debt investments, bonds, and secondary market investments. TCP Capital Corporation's investment objective is to achieve high total returns through current income and capital appreciation with an emphasis on principal protection. They're externally managed and they invest in companies with an enterprise value of between $100 million and $1.5 billion. As the name would imply, this BDC was launched by BlackRock. They're one of several major financial companies that have launched their own BDCs. Some other major companies with BDCs would include Blackstone, Apollo, Goldman Sachs, and the Carlyle Group. BlackRock has become well known for being the largest asset manager in the world, having accumulated $11.5 trillion worth of assets under management. That alone would likely add some confidence in people's minds regarding this BDC. You don't become the largest asset manager in the world by making bad investment decisions. But their BDC, when ranked by market cap, is actually ranked 22nd in terms of size, so they're by no means the largest business development company out there. But like I mentioned, they're offering a near 16% dividend yield, and they just paid an additional 10-cent special dividend on top of their regular 34-cent quarterly dividend. Usually when a company pays a special dividend, it's because they're doing extremely well or there was a one-off kind of event. With BDCs, they can issue a special dividend if they invest in a company and later exit the investment for a huge profit. This is something that one of Gladstone's BDCs recently did several months ago. So let's take a deep look at this stock to see if there's a good opportunity right now or if it's something that should be avoided by income investors. For starters, this company just recently completed a merger with another BDC back in March of last year. That company was called BlackRock Capital Investment Corporation, ticker BKCC. So in other words, BlackRock actually had two BDCs and they recently just merged them into just one. Blue Owl Capital Corporation is another BDC that just went through the exact same situation not too long ago. I'm not entirely sure why we'll sometimes see companies opting to have two business development companies with similar names and doing almost the exact same thing. In both cases though, they just decided to merge them together. For BlackRock, this also resulted in a management fee reduction going from 1.5% to 1.25%. There's two different kinds of BDCs that exist, which are internally managed and externally managed. Internally managed BDCs are generally regarded as being better because the board members are usually compensated based upon their stock's performance. Externally managed BDCs, on the other hand, pay the board based upon their assets under management. So there's less incentive for these external BDCs to perform well. Now there are some externally managed BDCs that are actually really good. Ares Capital and Sixth Street Specialty Lending are two examples of that, and both have been really good investments. TCPC is an externally managed BDC, but it's good to see them willingly reduce their management fee. It shows they do care more about their company's performance and it reduces their expenses, so that's definitely a positive for them. According to their website, they currently have 138 investments with a portfolio fair value of $1.9 billion. 91% of their portfolio is made up of senior secured debt, which is the safest kind of debt to have. It means they're going to be first in line to collect if a company they lend money to goes bankrupt. Overall, they're pretty well diversified across the number of positions they have, as well as what sectors they invest in. Internet software and services is their biggest individual sector, followed by just software, financial services, and consumer services. They don't hold cyclical investments, another good thing that a lot of BDCs typically avoid. From a total return perspective, this company isn't bad, but it's not great either. With dividends reinvested, you'd be looking at a total return of 139.34% since their IPO. That averages out to about 7.04% per year in gains. That trails behind a lot of other BDCs like Ares Capital, Blackstone's BDC, Sixth Street, and Hercules Capital. Of course, buying it when it's discounted or during dips could potentially lead to better returns if it's in a healthy position. Let's now take a look at their dividend payments. As mentioned earlier, they just paid a special dividend and they've actually done that 9 times throughout their company's history, 3 of which happened in the last 2 years. They did have a dividend cut in 2020, which was likely from COVID. A couple other companies that did go through a cut would include Bain Capital Specialty Finance and New Mountain Finance. So this is a bad stain on TCPC's track record. Their dividend coverage is also a bit of a mixed bag. They have this slide in their latest investor presentation that says, well-covered dividend, adjusted net investment income up 36 cents per share in Q3 2024, out-earned quarterly dividend of 34 cents per share paid on September 30th, 2024. You can see down here this comes out to 106% dividend coverage as of their most recent quarter. Compared to the majority of BDCs out there, 106% coverage is not something that I'd consider to be well covered. Several months ago, I made a video comparing the top BDCs and I provided this screenshot of their recent dividend coverages. With only one exception, most BDCs are currently reporting dividend coverage a lot higher than TCPC. Main Street Capital came out on top at 141% dividend coverage. But you can see that many are reporting at least 110 and 120% dividend coverage right now. In their most recent quarter, TCPC was only 2 cents off from reporting a 100% payout ratio. That does leave a little bit of wiggle room, but another concern I have is their falling coverage. 2023 was a really good year for this stock where it had some of the best dividend coverage in their history, but it's unfortunately been going down since then. So judging by the special dividend they just paid, it must have been the result of them exiting a position for a profit. They don't appear to be having a significant amount of excess earnings to pay out to shareholders right now. This metric is definitely going to be something to keep an eye on in the next quarter to see if this downward trend continues, because it's already close. On a more positive note, their non-accruals improved pretty significantly in Q3. Originally reporting a non-accrual rate of 4.9%, they made improvements and it's down to 3.9%. They went from being worse than average to right about average for a BDC. Despite the improvement, they did add another investment to their list of non-accruals, but what was taken off from their non-accruals list was far more significant. Another important slide to point out in this presentation on their website is what they refer to as their strong track record, book value per share, and dividends paid. Some other BDCs present this information on their websites about their cumulative dividend payments, specifically what's in the yellow bars here, and I hate that companies report this information. It's a misleading chart that doesn't prove anything in terms of their dividend consistency. It'll always go up unless they stop paying dividends. Let's look at a less confusing example that's presented more clearly. Prospect Capital, the king of dividend cuts in this sector, presents this same information in their investor presentation. It looks impressive, but this information is meaningless. This does not show their dividend amounts are increasing every year. It just adds up all of their total dividend payments. This is PSEC's actual dividend history, which is really poor. Going back to the presentation, the most important thing we need to look at is their book value per share, which is what's in this reddish-orange color. I'm assuming they added their cumulative dividends in yellow to try to make this look better, but their book value has been steadily falling for a very long time. This means the value of their investment portfolio has been decreasing, and it often increases the likelihood of a dividend cut. Some BDCs can have falling book values for a very long period of time, but TCPC's has been falling much more drastically than what's generally considered safe. So in the end, TCPC is looking pretty high risk in my opinion. Even though they offer lower yields, there's much better BDCs out there with great track records of dividend growth and overall better returns. I could see this as a speculative holding, but not something that you'd want to retire off of unless you're very confident they'll recover. If you want other BDC ideas, then check out the video I made where I compare the top BDCs based upon their most important metrics. I'll leave a link in the description below. Let me know your thoughts on TCPC. Do you hold it or do you think it's too risky? Feel free to leave a comment below, but with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.